A homeowner pays their mortgage on time, every single month, for years. Then one day a letter arrives saying their monthly payment is going up by a lot, and it has nothing to do with missing a payment or an interest rate change. This happens to hundreds of thousands of homeowners every year, and most of them have no idea why until it's already happened. The answer is something called an escrow account. For most homeowners with a mortgage, part of every monthly payment doesn't go toward the loan itself, it goes into an escrow account that the lender uses to pay property taxes and homeowners insurance on your behalf when those bills come due. Here's where the shock comes from. If your home's assessed value goes up, which has been happening broadly as home prices have risen, your property tax bill goes up too. And as covered in a related trend, homeowners' insurance premiums have also been climbing sharply in many areas. Both of those get paid out of your escrow account. When the amount actually needed for taxes and insurance ends up higher than what was collected in escrow that year, it creates what's called an escrow shortage. Lenders are required to review these accounts annually, and when they find a shortage, they have to fix it, usually by raising your monthly payment going forward to cover the higher costs, and sometimes by also requiring a lump sum payment to cover the existing gap. This is why a homeowner with a fixed-rate mortgage, someone who assumed their payment would never change, can still see their monthly bill jump by hundreds of dollars. The loan itself didn't change. The taxes and insurance wrapped inside the payment did. By law, mortgage servicers are required to send an annual escrow analysis statement that shows exactly how the account is being calculated, what came in, what went out, and what the new required payment will be. Most homeowners get this letter every year and never read it closely, which means the change ends up feeling like a surprise instead of something they saw coming months in advance. There are a few things worth doing with that letter instead of setting it aside. Check whether the projected tax and insurance amounts actually match what you're paying. Sometimes servicers use estimates that turn out to be wrong, and you can request a correction. If your local government's property tax assessment seems unusually high compared to similar homes nearby, most jurisdictions allow you to formally appeal it. And if the shortage includes a lump sum option versus spreading it across monthly payments, run the numbers on which actually costs you less over the year. It's also worth knowing that a spike in your area's home values doesn't automatically mean your specific tax bill matches every neighbor's. Assessments can vary based on when a home was last reassessed, renovations, and local exemptions, so it's always worth double-checking the number rather than assuming it's fixed. 3 things to do. Actually read your annual escrow analysis statement when it arrives. It's telling you about a payment change before it happens, not after. Check your property's tax assessment for errors or grounds for appeal. And if you get hit with an escrow shortage, ask your servicer about spreading the repayment over time instead of a lump sum, if that fits your budget better. The number on your mortgage statement isn't just about your loan. It's a bundle of costs that can shift even when the loan itself hasn't moved at all. We track the financial traps that don't make headlines so you're never caught off guard. If this helped, subscribe. We post every day. I'll see you in the next one.